Thanks for joining us tonight for the Some 180 Weekly Webcast, where we talk about real people's issues around their money and answer your questions. Tonight's issue is the decline in home ownership and why that's important for so many of us trying to build financial security. Home ownership is down 64% according to a recent report from Harvard University for a number of reasons. One is we haven't recovered yet fully from the 2008 housing crisis. And others, particularly for millennials, are around concerns about their job prospects and even their level of student loan debt, which is something we've talked about before. Shannon, a Some 180 client who's a 34-year-old living in Chicago, put it best. How much home can I really afford? Well, Shannon's plan told her to back into it from her income. Her combined income with her husband was $82,000, after tax around $65,000. And the answer is that you can generally afford about 2.5 times that take-home income, or about $162,000. Another check on that is that her costs, her total cost of home ownership, should not exceed 30% of her income, which is around $20,000. So as she prices out her mortgage and insurance and everything else, it should not really exceed that number, which is about $1,600 a month. We're really cheering Shannon on in her quest for home ownership because owning a home is the #1 wealth building asset for most of us in our efforts to build financial security. And that's for a number of reasons. First of all, the annual return in the housing market historically has been 4%, which is plenty to stay ahead of inflation. And maybe not as great as some of those high-flying years in the stock market, but a heck of a lot steadier. Secondly, some of the costs of home ownership can be written off on your taxes, like a portion of your interest, property taxes, and also insurance. So that gives you more take-home pay to save for other things. Thirdly, the improvements you make in your home can sometimes increase the value. And finally, if you get a longer-term mortgage, ideally at least 15 years, if not as much as 30, you're locking in your home ownership costs, and you're not at risk of having those costs increasing every year like you are in the rental market. We have time for one question tonight, so let's hear from one of our viewers.
Hi, Some 180. Have a question for you. I really want to refinance our home mortgage pretty much since we got the mortgage. So it's just a bit over a year old and we definitely want to refinance, but I'm trying to figure out what are the best steps we can do to go ahead and do that. I know about paying our bills on time, stuff like that. And also, what's the least expensive way, since it is only a year that we've had it, that we can go ahead and do this without it costing us a fortune out of pocket? Thanks.
Thanks, Melissa. Let's break down for you how to make refinancing your home easy and as cost-effective as possible. First thing to do is get to know what a good rate would be in your area. And you can do that by researching rates online. Bankrate.com is a good source for that. Secondly, you're going to contact the bank and start the process of discussions and negotiations. Now, it could be your current bank or it could be something that you've seen online. Alternatively, you could contact a mortgage broker who might have access to a wider range of loans and also who probably would even have some outside of your area that would be more cost effective. The third thing is to start the negotiations on closing costs. There are aspects of the closing costs that can be negotiated. So that's where you really want to get 2 or 3 estimates to compare. Finally, as you look across your 3 closing cost estimates, you'll be able to see if overall the deal is beneficial to you relative to where you are today. And if it is, go for it. And if it's not, wait for a better time. That's a wrap for tonight. Thanks for joining, and a special thanks for your comments and questions, because here at Some 180, we love making dealing with your money simple and doable.